And here we are for another weekly market recap or review or whatever. Um, I apologize in advance if my voice might sound a bit strange, but I'm a bit under the weather recently. It looks like autumn hit in full force, and you know, incidentally enough, I went out yesterday night and Saturday night, and I wasn't really dressed up accordingly to the weather. I was just wearing a t-shirt, and the voice of reason in my house. Basically, my girlfriend, she was like, honey, it looks like it's not gonna provide a lot of coverage. Considering the weather, the wind. Maybe you should come up with maybe a hoodie or a little bit of a light coat. And I was, yeah, forget it. I'm still young. A little bit of a cold never hurt anyone. So, and this morning I have a cold actually. So, you should always listen to the girlfriends. They always know better, right? It looks like. But anyway, beside that, the rest of the week was particularly busy, not only because the market was kind of all up and around and all over the place. It was a good market to trade, especially the NQ futures. But beside that, which kept me busy enough, especially in the afternoon. But the the other things which kept me busy was a little bit of a personal stuff in in real life. So lawyers, insurance companies, and whatnot. So I didn't have a lot of time to scan the internet for charts, for data, and macro stuff. And I guess a lot of you might be cheering to that. But anyway, I just collected a few screens about labor market statistics and whatnot. Just as a disclaimer, right? So after that, let's jump into the economic calendar as usual. So not the busiest week of all in terms of the amount of data points coming out, but of course it was what CPI week. So we know CPI. Next CPI is always the most important data until the next one, of course. And other than that, really, we got the ECB dropping rates, which was highly anticipated. Um, we got basically PPI, unemployment claims, but we always get that. And a 30-year bond auction right here, which I was particularly spot on it, just for the sake of it. I was expecting the data to be below 4.3%, in the context of looking at bonds. So I wasn't so sure, but I was just expecting a little bit of a weak uh, data point. At least in nominal terms. But then when you look at it, you know that if the rate it's lower, coming lower than expected or lower than previous one, you know that investors accepted to buy at the auction at a higher price because there's still this inverse relationship. And the second number here is just the bid to cover ratio. In short, it is just a ratio expressed in USD terms, so in monetary terms or currency terms, which consider the amount of bids and the amount of those bids which were actually satisfied. So it expresses the amount of demand for treasuries at auction, if you wish. So again, it looks like the bond market still, no matter what people are saying, we are still getting a little bit of attention to bonds, and the market seems to appreciate them and to actually want them, even if it's a 30-year, right? Now, of course, there's really nothing huge into this data point right here. Like, even if you look at the previous ones, what you see is basically that it got particularly stable since December 2023, getting into all 2024. Uh, what you got is basically this this value staying in the lower boundary of the 4%, which is okay, I guess, considering where yields are. So, and even the bid to cover ratio, you see that it stayed in this range in between 4.7 and 4.3 to the downside. So the bond market so far looks particularly stable to me, but I just jumped to the to the end of the week just because my eyes were caught by this data point right here. But other than that, CPI came in line with expectations. The only thing might be or was the shelter component of it was still a bit hotter than expected. So you see the core coming in a bit hotter. Not majorly, right? It's just 0.3. It was expected and 0.2. But again, if we look at a trend, it's still coming down, right? As pretty much for the rest of it, everything is still coming down. Now, I do think, and this is just my thought, so could be wrong, could be right, whatever, as usual, right? I do think, the sticky part of inflation might take a little bit to catch up with the headline CPI number, but, eventually it will. So, that's why you call it sticky, right? Otherwise, it wouldn't be sticky. If it wasn't a little bit more sluggish, more sloppy to move up and around, and in this case, to come back down. Um, Again, for PPI, we got the same. The data came in a bit hotter, even than expected, and even compared to the previous one. But again, uh, I don't like. I know the headline number is always important to check because the market, no matter how you see it, the market is gonna react to the headline when it comes out. Then, of course, we are gonna be worried about the potential revisions later. But the headline, especially if you do trade intraday, still something you want to pay attention to. But if you then start to zoom out and look at things, let's say from the daily perspective or weekly or monthly perspective, then what you want to check again is the trend, not the actual data right here, right now, because it might be volatile. We went through the same argument. I guess it was 2 weeks ago, maybe, when I was talking about retail sales and how the data is volatile. So you need to check other stuff relative to that data to smooth it out and having a little bit of a much cleaner type of a read. Okay, so this was the economic calendar, and these were the data points for this week. So let's check how the market reacted. Now, gold. Let's start out with gold. Gold just ended up the week with strength. If you remember, I was a little bit concerned about the slowdown in gold. I was almost starting to looking for failures, right? And I was, saying, where would you draw a line here? Why would you say the structure is shifting to the downside? And where would you start to expect a little bit of a pullback in gold? Well, it turns out it was sideways for what? Uh, that was August 23rd. So it's been sideways for almost a month, a good 3 weeks here. But eventually it broke to the upside once again. Now, let's see, do we got nothing particularly interesting in terms of volumes? You don't see a real spike one way or the other, but these are daily volumes anyway, so. As for the tiny indicator, the only one I use, well, looks, let's say, kind of neutral at this current moment in time. But again, I remember I brought that up when I was talking. It was gold, and then I transitioned into BTC talking about that one. It's just an indicator I use for intraday type of trading. And as I said, as a disclaimer in the previous videos, I don't really know how much validity it might have on a daily time frame or a higher time frame base. So, I'm just looking for the sake of it, and maybe it's more of a process of trying to verify it actually, instead of putting on it a lot of weight. I'm actually checking it once a week to see if it, over time it might signal something which is worth to be paid attention to, right? But again, gold, after a strong week like this, or at least a strong close or end of the week, yeah, again, I mean, the trend is the trend, so you need to keep on being bullish gold. Uh, the only one thing I saw about gold was this, and I know maybe a lot of folks are actually already know this type of relationship, but it might be good to check. Like, you see the spot gold in blue versus gold miners. So, sometimes I've read and I've heard. I actually know a guy, which incidentally is Italian, same as me, which is engaging in these trades on gold miners. So I don't know, he might be interested in knowing this if it doesn't know already, which I would assume it does already. But anyway, often people tend to play gold miners as a lagger of the actual spot, the underlying price, right? So you might say gold goes up, so with a little bit of a lag, miners will follow, and they will catch up, and they are a little bit more volatile. So you might say you're playing a leveraged type of trade on gold by playing the miners, or at least that's the logic I've heard of, right? I'm not saying it's right or wrong. It's just that's what I heard, talking with people, reading online, and stuff like that. This just shows you that although it might be true, right? But since 1994, it looks like miners really underperformed, as you can read in the data, right? And as you can see in the chart, right? So again, it might be another one of those kind of narrative shifting type of arguments, right? You see a lot of people are playing this type of trade, and they give you the logics and the reasons, but then if you actually check the historical data, what you could come up with as a conclusion could be, why should I be worried getting in and out of the miners when I could just hold the underlying, which is performing way better over time? Of course, if this is a long-term play. If you are just kind of playing short-term trades like intra-week or intra-month, so to speak, then you might have completely different arguments for it, and it might be totally cool for you to do so. I was just pointing out the fact that over time, it looks like holding the actual commodity might produce better results than play the miners, right? So, yeah, again, just tiny thing. One of the few I actually collected this week. Busy week, right? Let's move on to Bitcoin. Again, Bitcoin. Look, still, I don't see a lot of enthusiasm, right? Now you might say, yeah, okay, hooray, the lows have been defended once again. Yeah, sure, but at the same time, you didn't, at least yet, broke any relevant level to the upside, and it's been like that since March, essentially. It's quite a bit of time. This range is going on since March, and I guess the thing would be you're about to see what's going to happen when it breaks out, because the more it compresses, the more explosive the move coming off of it will be, you know, huge, a lot of extension, a lot of expansion after this contraction, right? Yeah, I might agree with that. We do know that contraction leads to expansion, contraction volatility leads to expansion in volatility, so it's always a cycle, right? It's the same of the market starts with a consolidation, then it goes for a trend, then it gets back into a consolidation, and then from there it could be for continuation, so a new expansion, or it could go for a pullback, so expansion to the other side, coming back down. Same principle applies right here. What I might say is this line right here is still, I guess, relevant, right? There was previous expected support, flipped very quickly into resistance. Let's zoom out a little bit, because I do know OBS has the tendency to not be particularly high resolution when it comes down to these tiny shadows or wicks right here, right? So a price is still living below that relevant level, which was broken and retested and flipped. So again, it would be a starting point, right? Now I know if you do believe in it long term, this is a huge chance to accumulate that at a discount. If you believe that maybe over the next 6 months, 1 year, whatever, it might goes up to 100, 125, whatever you. I'm just looking at it, on a week by week base, right? So again, I'm not really interested in where it's gonna go 6 months out. I'm just looking at what it could be, and since this is a weekly recap, and what was the week which just went out, and potentially what could be the week which are about to see, just in less than 24 hours at this point. So again, I would look at this level again and see if we can break through and maybe a retest of the level above it, or if it rejects price once again. Because at the end of it, if you look at this section right here, right, you got the sharp drawback, the sharp dump, the drawback in here, price accumulates a bit, it goes for a deeper retest into the apex, and it was rejected violently at that point. So, could this be on a different type of a scale, right? But could these be another fractal? Oh, by the way, we got the same in here, right? An apex is formed, price shoots down, it shoots down once again, then it has a little bit of a drawback, taking a high, but eventually finding resistance in that previous apex, kind of like here, right? That's the high, which is taken out while price tests back into the previous apex. So, could this be the same right here? We might have price drawing back, taking out a few highs right in here, retesting the previous relevant level, and then being rejected. Could be not. I would just say I would still take it on a defensive side. Although if you look at stocks and equities, if you look at the indices, that would bring you to be a bit more hopeful, bullish oriented on Bitcoin, since they are both risk on assets. I actually just asked this question in a server. I mean, because just for the sake of it, I don't even have the screenshot right here, but I was looking at the seasonality for the equities, and it looks like for equities, September is a bearish type of a month, as we discussed last week. And the worst part of the drawdown that you suffer in September historically tends to happen in the second half of September. While instead I was talking with a person which collected a good amount of data on Bitcoin, and it looks like on Bitcoin it's kind of the opposite. Yeah, September tend to be a bearish month, but the majority of the drawdown actually comes in the first half of September. So those would be two conflicting arguments if you take them both together. And if you start to apply a little bit of a correlation on them, you might say, which one is right? I guess the conclusion of keep on looking at two different assets in isolation might be good if you are a day trader. Still, on a macro scale, I still think that type of correlation could be relevant in the coming weeks. So again, we're gonna see what's going on. I was just thinking to some degree it could be relevant, but I I get the point that from a a trading plan standpoint, it's not really a huge help. So we'll see about that. Um, let's have a look, same as we did for gold. Tiny, I don't want to call it magic indicator because it's not. It's just an indicator like any other else you can find, or any other one you can find, and it doesn't really give you the holy grail of trading, of direction, or investing. No, it's just just an indicator. So it was interesting because in Bitcoin it tends to, at least throughout this month, it tended to work out particularly well, both from the standpoint of divergences, like you see price is going high right here, but the indicator is flat and it's kind of finding resistance at the moving average. And then eventually you see Bitcoin dropping. Then the moving averages actually crosses to the downside with the faster crossing below the slower. You see the indicator getting up, testing into the cross, while Bitcoin is testing into an apex. And what happens next? You got rejection. Then, on this rejection right here, the indicator stayed below the fast moving average. So again, and now we're just approaching the fast moving average and we are approaching kind of a relevant level. So I don't know. I guess we are about to see. I'm just monitoring it on a higher time frame base because I do know it works intraday, but that's just, 1 minute, 15 seconds type of bullshit. So higher time frame might be completely different. Although, I do subscribe to the idea that price is fractal, so, might be a reason I'm keep watching it. Let's move on. Let's look at oil. Oil tried to put together a bounce. It looks like didn't really reclaim any relevant level. So again, as for now, I might say still particularly bearish from just looking at the charts. Now again, since I've been here before, be very careful when a market it's so overextended one way or the other, because you might get a little bit of a pullback, right? So getting into next week, I guess the first 2 days, usually Monday, Tuesday, could be interesting to look at it and see if it shows evidences of wanting to do one thing or the other. It could be going for a continuation, so you might see a redistribution pattern, and probably not over time frame, like maybe the hourly time frame, intraday, right? Or it could start, maybe it opens up the week where Monday putting in the low, and then it rallies, filling in this weak leg to the downside. Could be. Just for the sake of it, just let me try to do something like this. I know it might not be worth anything, but just for the sake of it, that would be your range high. I mean, I'm just looking at this dealing range right here. So the midpoint would be here, which would be kind of in line with previous lows. So that might be your first level of resistance. Let's throw at it an ordinary Fibonacci. Like, yeah, the golden pocket would be here. Again, support, 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 support giving. So it would be in line with previous support, right? And this point of release on the daily, kind of in this pocket, still would be drawing back to premium relative to this uh, trading range, the dealing range, this leg down. But the way it's, the area it is at right now, to me, would be a no trade area. Like I would like to see it either confirming further continuation down before keep on shorting it, or putting in a little bit of a low right here. Intraday might be similar to something like this, right? Price comes back down, goes for a little bit of a bounce, and it comes back down again, tries again, and establish a low, right? Like here, and then you might see after something which resembles it is happened. Intraday could be the hourly, could be the 15 minutes, could be whatever. At this point, I might say, you know what? this is happening right here at this level. So at this point, I might see the, this asset drawing back higher a little bit, and then we'll see if the bounce is fitted or if it's not. Um, Fundamentally, as usual, the break evens didn't really give any type of a signal. I'm talking about divergence, of course. They kept on going down with the price of oil, and they just, slowed down and actually went flat. But again, yet they didn't reclaim any relevant high. So there is no switch, a shift in the trend of the break even so far. And even if it is, I wouldn't take these highs right here, the August 29th high. Now I might be too conservative, but I would like to see, in order to get a shift in this trend, I would like to see these highs taken out and traded above and sustained above, right? I know the value right here, it's getting in the way, but if you look at the cursor, as the pointer of the mouse, these are the highs I would look at. Conservative, maybe too much. Yeah, I mean, you might say, yeah, at this point you would have lost half of the move most likely. Who the fuck cares? I'm not here to catch tops and bottoms. I'm here to trade a market which has a little bit of a clean and clear direction. You know what? I guess it doesn't matter if you don't take the entirety of the move. Sometimes even 50% of a move is more than enough to make a living. So fuck that mentality. You know what? Catching tops and bottoms. That's shit. Let's have a look at the curves, I mean the futures. And of course, if you look at the October, November, December, so getting into the end of 2024, futures are still pricing in lower prices. Now, I got this question like, why don't you look out more than 3 months? Well, because, you could look at the July 25 contract right now, but first I would assume the amount of liquidity on that contract it's just bullshit at the current moment in time. And you actually you can check it. You just need to click to the specific contract you want, and you can see the open interest, the volumes, the flows, and whatnot. And I think predictions are oftentimes they're good for a week, but if you really want to be generous, I think predictions are good for maybe 30 days, a month, and then you always have to reassess. So I take, in this case, 3 months just because I want to kind of grasp the sentiment of the market for the next quarter, so to speak. It's kind of like, I guess the same logic would apply when you look at, I don't know, 3 months so for futures, or when you look at the near-term forward spread. Usually is a quarter ahead, right, as a forecast. So that's why I'm always focused on the first 3, 4 contracts on the list, and I'm not going further because I think that even if you think the market it's forward looking, I think the outlook and the forecasting and predicting capabilities of markets has a little bit of a limit, right? So, and then you will have new data points coming in, new events, new stuff happening. So just focus on what is, in the near term future, I would say. Um, what's interesting, I say, looking at this chart, right, and how it was in a downtrend basically since, wow, September, October 2023. But, we got a little bit of a bounce getting into this, again, China rebounding, China reopening, China roaring back. Yeah, that didn't work that well, did it? But there is also the narrative about the Saudis. The Saudis, the OPEC, massive cuts of production, right? Now, that is true, of course. And, in and of itself, that would be kind of like, they're cutting production, but price is going down anyway. So, I mean, where's the demand? If the supply is contracting and price is going down, it means that demand it is contracting even at an even faster pace, right? So I just checked for the sake of it. I went and checked what the United States are doing, because if you don't know, uh, the leading oil producer on earth are the United States. They produce the most amount of barrels per day, per year, you name it, on the entire planet. So we are always focused on the Middle East and the OPEC and whatnot, but there are other huge actors in the oil market, like the US, Russia, um, Venezuela, for instance. And now we know in the I always spell that out particularly bad, but Guyana, something with Guyana in it, but it's a region in South America which should be pretty full to the brim with oil, natural gas, and whatnot. So there are many regions in other parts of the world outside of the Middle East which are capable of producing huge amount of oil. So I was just looking at the US, and it looks like starting 2024, they actually increased that production. So again, it ties in a little bit with the supply demand dynamic. So you might say, okay, so the Saudis are cutting production, and most likely I would say it's because they want to manipulate the price, since their revenues mostly come from oil. They would like to have oil at a higher prices, right? So they can profit more from the sales of their favorite commodity. The United States actually increased production, so you should say again, on one side, supply it's restricting, contracting, but on the other side, let's say the US, supply is increasing because they are producing more. And we do know that still we got the Russian oil. There is an embargo from the West on Russian oil, or at least there should be, but yeah, you know. But we also know that Russia is basically selling out the cheap oil to India, and they are going to bilateral transactions, circumventing the USD system, and they are, I guess, they are selling in rupees, maybe. Yeah. So there is still the supply available. Um, so I guess whatever and however you like to cut it, with different degrees, of course, and to different extents, but still, demand is falling uh, faster than how the supply component it's behaving. Now, you might come up with different arguments about the magnitude at which, or the speed at which supply and demand are moving relative to each other. Still, for that, I think at the end of it, you just need to look at the price, which is still, as we are gonna see, deflationary. So, yeah, that was just a tiny little component I wanted to add, because I guess it helps me to tone down my own expectations a little bit. If you just look at the Saudi versus price of oil, you might say, as I said in the beginning, demand is just evaporating, like it's going real fast. But then you look at the other components, like the US in this case, or Russia, or Venezuela, or whatever you want to add, and you say, okay, maybe supply it's not really contracting as the headline and the news would like us to believe, but yeah, still anyway, price is going down, and you kind of rebalance expectations by doing so, right? That's it, and there's nothing more to read into it. Let's look at yields for a minute. Uh, they had kind of a stable week. Okay, this was Monday for the long end. Actually, this was Monday, yeah. And again, let's zoom in a little bit. Went down, it came back up. close down again. The mid part of the curve, kind of the same. The short end, the one with a weaker close was this. So I I don't see a lot of movement as for the week in yields. Still, I do think yields will go lower, right? Um, Remember last week videos, we are in a what it looks like a bull steepener when it comes down to bonds. So again, uh, this stuff right here, and this is just a proxy. Of course, I'm looking at the ETFs continuously. You might want to look at the different futures for bonds. Like that would be what? They all start with a Z, and I don't have them right here. It should be in the futures one. Yeah, the ZB, the ZN, the ZF, and ZT. Would you say those are a better grasp on the market? Maybe, maybe not. Just for the sake of it, I'm looking at the ETFs to have a broad understanding. Also because I'm exposed to the ETFs, so I keep on monitoring these. Again, as usual, my bias on bonds didn't really change. I think they're set to go higher. I mean, it just J Powell is about to cut, so you know, yields down, and bonds price is higher. Now, I wanted, um, since we're talking about the yields, the bonds, and the Fed, just for the sake of it, I guess everyone knows it, but yield curve is now uninverted, and this uninversion right here, it's you know it's going on since September the 6th. So now is it starting to be sustained, substantial, confirmed, whatever other term you might want to use. Because I was saying in the past, it's not the potential head fake you need to look at. It's the data uninverting and staying uninverted. That's usually what gives the signal a much higher validity. Looks like we are getting there slowly but surely. Could we get a little bit of a pullback before it coming back up? Yeah, absolutely. As we discussed last week, if you don't want to get back to it, just have a look at these. Yeah, so it might be we might have a little bit of a pullback, a little bit of a dancing around the zero line like we had in the past. It's totally in the realm of possibilities. But as for now, we are uninverted by almost 10 basis points. So that's the update for the yield curve. Um, when it comes down to rates, I wanted to look at these a little bit, just for 1 minute, because I was in that tiny bit of free time I had. I was looking at commentaries, comments, talking heads, and whatnot, and it looks like now the great debate is in between the 25 basis points cut and the 50 basis points cut. Now, I'm not going to stay here arguing that I do know what the Fed should do or I do know what they will do. No. And the market seems particularly split on the outcome. It's just a 50-50, right? But again, when you look at FedWatch, this chart right here, if you were looking at it, let's say in the middle of the week, it was up and around all over the place once again. And the recent commentaries I was reading were about, you know what, these CPI data confirms that the Fed is going to go for a 25 basis points because although the headline came in, uh, as for expectations, and if you look at the the data series, it's basically the lowest read that we had since, I guess. Now, I don't remember, but it was a long period of time. Maybe March? But I don't remember the year though, so it's kind of pointless to discuss it. The bottom line is these expectations, as priced in by the futures market, people are using this argument to say that they need to go for a 25 basis points. They need to go for a 25 basis points. It's like it's mandatory, right? Or the data that we've seen as for CPI solidified the 25. But just by looking at these, I was like, okay, so it changed around because throughout the week, this was like the 25 were priced in like at 70%, and this was priced in, the 50 basis points was priced in at 20, 25, Oh, actually, it's there. But even if you look at August, right? For the month of August, you had a 25% chance of a 50 basis points cut and a 75, of course, for the 25. But even if you look at these and you look at the current one, it looks like the odds for a 50 basis point cut, they actually increased compared to last month. So, instead of looking at and listening to talking heads, you might want to look again at the data series, not in terms of the actual value or the headline, but the trend, right? So it looks like we shifted toward a much hawkish type of cut. Now, again, I don't know what's going to be. Nobody knows up until the old man will come up and saying it out, stating it out loud. But let's try to build up a case, all right, and see if it goes on the way I might think or not. So let's look at these in terms of what the Fed should do. A little bit of a mental exercise. What if I was Jay Powell? Because in my opinion, if I was Jay Powell, well, first of all, I think I should have cut back in July a quarter of a percent, so 25 basis points, right? And I think this type of a thought could be confirmed by what you've heard coming out, not only from Jay Powell but all the other board members throughout these 2 months, right? They kept on saying now it's time for policy to adjust. Now we are shifting our attention to the other side of our dual mandate, which is employment, because they probably had a look at the unemployment trend kind of accelerating above 4% because they started to pay attention to all these sum rule talking and whatnot. So now they're shifting the gears, right? Um, the thing is, to get to the bottom of it, I think they should go for a 50 basis points cut, all right? Because it's just in terms of opportunities. If I remember correctly, they don't get an FOMC meeting in November, in the month of the election. Let's just check it out. FOMC. Just to have a little bit of a calendar. Mm, 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 Wait, do they have it? Actually, they do. Okay, I might be wrong on that. But let's just say for a minute. Okay, let's go back to it. I was wrong on it. Good, good Lord, I checked. Better that way. But let's say, uh, let's put it this way. From here to November, they don't really have another chance to drop rates in a substantial way. if they go for just a tiny 25 basis points right here, right now, okay? Yeah, they might get, the problem I see is, if I'm Powell, what if after stating that maybe we should have cut back in July, maybe we underestimated the cooling off of the labor market. I guess if you don't go for a cut right there and just cut 50 basis points, you kind of keep on being behind the curve, right? And that would force you to have much bigger cuts getting into then October and potentially November, right ahead of the elections, which with all the implications, right? Hey, what's going on? We are in October, 1 month ahead of the election, and Powell is cutting rates by 50, 75 basis points. Hey, he's got political right here. He's trying to help the incumbent because he knows that if Trump's get away with that, he's going to be out of office, because we do know they don't have a good history in between one and each other, right? So that is the political risk to some degree. Um, Plus, you got the chance that the data will keep on deteriorating even faster. So I know that they stated that they wanted to be data dependent, but I mean, aren't the data already bad enough to justify a 50 basis point cut? I mean, my view would be, again, this is just what if I was in Powell's shoes, right? I'm not saying that's what's going to happen, and I'm not saying I'm going to put a dime on it. It's just a mental exercise, so for the sake of it. So I would go for a 50 basis points cut, and then, even comparing myself to what the other central banks around the world are doing, like Bank of Canada, the ECB, just to name two, and then I'll wait and see how the market responds. Now, the counter argument would be, yeah, but if they go with a 50 now, they face two risks. One, inflation reignition, all right, which of course would be a massive, bullet in the foot, because after taking 2 years to quote unquote win the fight against inflation, if then you give in too soon, might be that the all those efforts might be just nullified. And the other one, it's more related to financial markets. Let's say the market is expecting a 25 basis points, and you give them 50. First of all, the market might think, wait, the S&P is what, less than 2%? At least at this current moment in time. We will need to see what it's going to be in 3 days, basically. But let's say it's 2% away from all-time highs. Doesn't look a weak market. Why would you need to cut 50 basis points? Oh, wait, guys, the old man, he knows something we don't know. We need to de-risk because he sees risks that maybe we don't see. So just in case, for the sake of it, just to be sure, for the sake of safety, you know what? Just unload a little bit of our positions, just de-risk a little bit here, and then you got the market plunging. So maybe that's not the best. Again, getting into elections. If the markets are already, if at least if you think the markets are already a little bit on their feet, you don't want to give them a reason to completely go high wire, right? So that would be the counter argument. Again, my standpoint is that they should cut 50 basis points and then reassess. But hey, I'm not Jay Powell. God forbid, I don't want to be him, right? Just because if we look at the behavior of, in here you can see the two years treasury yield in red and effective Fed funds. Well, now this is just going back to the 19s, but which again it would be 35 years of history and 1, 2, 3, 4 recessions in the middle, right? But it looks like the Fed is really mimicking what the 2 years is doing. So again, it goes back to my thesis that no no matter how you cut it and slice it, it is the market which is leading the Fed. It's not the Fed leading the market, right? But that's an old story. But the media would like to sell you the other side of the story, just for the psyop that the Fed is constantly conducing. But at the end of the day, I still think they are not in control of shit, and they are just reacting to what the market is doing. So you see in red the 2 years, it tends to go down first, and then Fed funds catch up. Now in the 90s, right here, you see that then Fed funds comes back down in line with the 2 years, and then the 2 years take another deep dive. I just inverted. That might be dyslexic. And then again, you see in here 2000, the 2 year in red goes first. Then you see in the background, Fed funds catches up, and then the 2 years had another nosedive to the downside. And again, you see it in 2008. There is this little bit of a pause on the 2 year while the Fed is catching up. And then down we go again, both on the 2 year and Fed funds. And again, same in 2019, 2020. Now you might say, yeah, but we got COVID. That's a big outlier. It might be a big outlier. I would see it just as a catalyst, not an outlier, because it's behaving exactly as it did before. Because at that point, you might say, oh, financial crisis, 2008, that was an outlier. Dot-com bubble, that was an outlier. And I don't even remember what it was at the beginning of the 90s. What was that? The SNL type of crisis, maybe? Don't remember. Still, just was just looking at these to kind of come up with a bit of a context, an idea around Fed funds and what they're going to do in 3 days, basically. The bottom line is I'm still bullish on the treasuries, the bonds, um, and so I'm holding my positions in there. Now, finally, back to indices. Indices came back up quite a bit in full force. If you look at the daily, these are the futures, of course, for September. The S&P really just traded back into this pocket, but now you might have all the definitions you want. To me, it's a pocket of liquidity. It's actually a balanced price range because you got imbalance to the downside right here, rebalanced. So this range now it's balanced, the inefficiency, the imbalance has been closed in. So there is no need to get back into that. And if we get back into it, we kind of bounce hard. So some sort of a type of a behavior I use intraday on a different time scale. Looks like it worked this time around on a high time frame base too. So again, so does it look bullish? Does it look bearish? I say, in order to not commit the same mistake once again, I'd say, you know what, it looks just a consolidation, really. It looks more neutral than anything else. Now, it depends on your disposition, probably. I'd say at this point, I'm still seeing NQ's futures not leading the charge. I'm still seeing the Dow to some degree being even better than both of these two. And to me, that wouldn't make any sense in a real bull market phase because you would like to see your growth stocks, your tech stocks leading the charge to the upside and not the industrial sector, at least historically, right? Even if you look at it like this, and now let's exclude the Dow for a minute. If you look at these, what you see is that we basically bounced up and around the 100-day moving average. We reclaimed the faster moving averages, so the 20, the 50, and they were at the end of it upside sloped with the 20 crossed above the 50s. So might be that. Now, the thing is, we're very close to all-time highs, so that leaves the door open for what? A double, a triple top? I mean, I don't know. Again, I only believe in tops and bottoms when I see them, right? But maintaining this little bit of a neutral bias getting into next week, what I would say is up until we can clear out these highs, preferably with a sharp move to the upside and a little bit of volumes coming in. Um, I'm just, I would say just play the range. NQ is a bit weaker once again. So, well, I mean, the triple Qs in this case. So, I honestly don't know what to make of it, right? You gotta be honest. Sometimes, after kind of being wrong 2 times in a row, if you remember, or you just say, you know what, let's go into reassess and let's wait for the market to actually make up his mind. Now, at the end of it, doesn't really impact my trading. Actually, this week was fantastic, especially because it was so volatile and it was so mean reverting that it was just fantastic. CPI Wednesday was crazy, crazy day. Um, the market went down at the open. It touched into the VWAP third standard deviation, rated the previous day low, and then just shoot it back higher. So I played at least one short after the open, and then I played two longs while it was mean reverting. When it reclaimed the second standard deviation and when it reclaimed the first, I short it. I longed to VWAP. Then, of course, it kept on rallying in the second half of the day for New York, but at that time, I'm already at dinner basically because of the time zone difference. So um, let's just be neutral on these on a daily time frame base. But be aware that if it keeps on being so volatile, you might have a lot of chances intraday, right? So why wouldn't you play them? Okay. Um, there is just I guess one thing when it comes down to these rates and inflation and whatnot. Before I forget, there was this tweet which basically say that all the categories, excluding shelter, are below the 2% target that the Fed should have. Um, I was lost in my train of thought, so I, I forgot to bring this up. But this is just confirms what I was saying. If I was Powell, I would cut a 50 basis point right here, just for the sake of it, right? And let's close this down. Now, uh, the only data points, well, not really data points, but just charts I collected for this week were about the labor market once again. So again, just as I traditionally do, just to highlight a little bit of potential risks, because I do like to keep on looking for risks, right? Um, I guess it's just a little bit of a mindset, right? You might say, the market is going well, price action is going as expected, everything is bullish, everything is green, my portfolio is going up. So what you really need to pay attention to is what could change the status quo, right? How how and why would I shift from being in the green to being in the red? And for this week, the only type of risks I managed to collect to kind of put together a decent discussion was about the labor market and how the labor market and unemployment could impact the stock market. All right. Now, first and foremost, we need to agree on this simple base premise that the US economy is mainly a consumption economy, 70% type of consumption economy. So the demand on the side of the consumers, it's what drives economic growth, right? In order to be able to consume, you need to produce first. So you need to do something productive, which brings in your personal pocket, funds, currencies, money, something that you can spend then, an income basically, right? A paycheck that you can then spend in order to consume, right? Uh, your consumption, as we discussed, I guess a month ago, your expenses, your spending is someone else revenue or income, and so on and so forth. So if you spend more, corporates tend to have better revenues and better profits. And so the whole economic machine, it's working perfectly, right? Because then companies want to expand, want to hire more, to produce more, to meet that demand. Okay, so this first and foremost. The main focus, of course, to start this cycle, I guess, would be having an income, something that you can then spend to fuel the economic machine. Now, although, the data are not so rosy when you look at, in this case, employment, but, you can flip it to unemployment, it's still the same thing. We're still talking the same principle right here. So unemployment alone or employment alone, it doesn't really give out a good depiction of what the circumstances might be, because then you might want to check something like this, which is full-time employment. And of course, there is no need to clarify that full-time, it's way better than having a part-time job. Not only in terms, of the amount of income that can give you, but even if you think of the logics behind it, in a normal growing and red hot economy, everyone should have a full-time job. You wouldn't need to have multiple part-time jobs in order to make ends meet, right? But it looks like full-time employment year-over-year change actually declined, and it's been on a declining trajectory since basically 2020. I'd say 21, just approximating, but over the last 2 years plus, which is not good in and of itself. And you see that when it goes negative, usually, again, gray shaded areas, a recession is about to come in. So this is a recessionary type of warning. Now, again, does it have to happen tomorrow? It could be 3 months from now. It could be in 2025. Who knows? I'm just saying this is a risk you want to put on your radar, just for the sake of it, right? Just to be, prepared, right? Then going ahead, you see that since 2023, we added a lot of part-time jobs in black, and at the same time, we lost a good amount of full-time jobs. Again, not cool, right? And here you can see a comparison in between the full-time employment with the working age population. Again, you would expect this number in a healthy and growing economy to go up, like we were seeing coming out of the 80s, right? To some degree after the dot-com, or basically throughout the 90s and the early 2000s, right here, right? Uh, and of course, as highlighted in here, tech kind of plays a big role in it. And now I know a lot of people are massively bullish on AI, which why not? At least if you are invested or if you plan to invest in those companies which will benefit the more from the implementation of AI. But I always have this type of a doubt. What for the rest of the population? Is it so bullish AI for your standard of living, for your job, for your income capabilities? I don't know. I think that's at least a question the average Joe would need to ask himself instead of spending time asking dumb shit question to chat GPT, right? Uh, and I keep on getting back to that wonderful meme about AI where you have on one side, it's kind of a screenshot, right? On one side, you have a man dreaming about AI and saying, you know what, when AI will become a thing, it will do all the work for me. And I will be free to have my time to spend my days doing what I like, not what I need to do, but what I like to do, like art, picture, songs, music. And on the other side of the meme, you got now uh, where AI is now here, and everything he's doing is producing music, making pictures, making images, and I'm still stuck here having to do what I need to do. I'm still making the dishes, I'm still making the laundry, I'm still working 9 to 5 while AI is real now. So that was a meme which I always laughs at it, right? So getting on the chart about the income, and so getting back to the first chart, your income, your spending, and someone else's revenues and whatnot, it tends to have an impact on GDP, of course. Now, this is GDP against the I guess EPS should be earnings per share. So the percentage change in GDP, sorry, in earnings per share versus monthly GDP. Now, they tend to be correlated pretty much. And why is that? Well, of course, because if you're spending in someone else's revenues, if your spending goes up, those revenues goes up, and the price of the stock of your company will go up because you are generating revenues and earnings. It's just, if you think of the PEI ratio, right? Stocks tend to appreciate the most when they prove that they can generate earnings. So that is another important component of the whole logic in here. Now, of course, you see the annual change in earnings is a good uh, indicator of market returns. So you see when estimated, because it's forward, right? When forward earnings per share are going up, the annual rate of change of the S&P is going up, higher again, because again, more earnings, more revenues, best evaluations for stocks, right? But that is all, that also works in reverse. So when you got estimates being cut and earnings forecasted lower, then you see uh, the stocks and equities evaluations being repriced lower. This is just a fundamental type of analysis, right? And, you know, again, market values reflects the change in these earnings estimates. And you see the price to earning based on forward estimates and the S&P annual rate of change. So all of these is particularly correlated. Now, you might say, so what's the point? Well, the point is that when you go and look at, the unemployment claims or the, by the way, unemployment claims, they came in, and where do they wear? Let's see. Oh, well, it looks like they are still coming relatively up. Not at the same pace they were uh, in, May, July, whatnot. But, plus, got a little bit of a seasonality in August, holiday season or whatnot. Might be you see a resurgence in hiring, maybe. But anyway, they're not going down, that's for sure. At least you can see they're stable. So, you know, those screenshots, those slides, they come into play when you think about what could be the unemployment situation. So you look at the unemployment data, you look at the sum rule, and then you look at what that could mean maybe 1, 2, 3 months down the road for earnings, for corporate earnings, and therefore for P ratio, and therefore for equities and stocks evaluation, right? So this is why might be again not tomorrow, not next week, not next month, but it could be something you want to monitor and see how the market reacts to those data points coming in and the trend of those data points staying on this trajectory or maybe reverting, or it's still something you should pay attention if you operate on a larger time frame or a larger time frame horizon, basically investing. Again, just to assess risks, nothing more than that. As for this week, last few days, 5 days, we have seen that these bounce in the major indices was actually paired up. It was matched by good numbers in what you should see in a phase of expansion and bull market. Consumer discretionary, communications, of course, technology. Now, just for the sake of it, when you look at this price action right here, especially if you look on the hourly time frame, I might say a lot of these, to be fair, and again, I don't have any proof. It's just thought experiments, right? A bit of these might be due to short cover, right? People which have might been short, they are actually now covering, and that what's led the bounce pretty much. Now, does it give any indications on the future? Most likely, no, not that much. But I guess it could at least say, one thing is actual buying, one thing is short cover. I know that the end result is the same. It provides buying pressure into the market, in the underlying, right? If you want to try to build up a narrative on it, you might say, you know what, it could be getting especially into Friday, Thursday, Friday, so the end of the week, market participants just decided to get a bit more neutral, considering that we are getting into the FOMC next week. Could be that. They don't want to be caught in something which could send the market either massively up or massively down. So maybe they just, you know what, it was a good short, it was a good run to the downside. Let's bank in the profits and let's get back to neutral and see what happens when the old man talks in the middle of next week. Could be something like it. I don't know. Maybe. I mean, it could be. Um, what I do think it's not, right? I read, especially after the debate, right? Which the debate was on Tuesday, that was September the 10th, I guess. And I read, yeah, you know what, the stock market, it's going higher because this is basically a little bit of an optimism linked to the fact that Kamala Harris actually won the debate. And I was like, gee, how? I mean, again, I don't have all the answers, but how can you fucking believe this bullshit? Uh, Look, first and foremost, uh, did she actually win? I mean, it's just a survey. Who knows? Plus, are we sure that even if you won the debate, she's gonna she's gonna win the election after that? And even if she wins the elections, are we sure that all the policies, all the promises that she's giving out right now are gonna be delivered? No, I mean, no. But most importantly, if she truly won, why didn't the market just rally overnight? Wait, well, again, why did the market had to puke like this on CPI day? Doesn't make any fucking sense, right? If it was optimism, it should have just shoot higher. But no, you know what? That's another thing. On the CPI day, while the data came in and the market plunged, right here, and same for the NQs, at a point in all of these, we got the Nvidia CEO coming out and saying, oh, we can't keep up the pace with demand for these chips. And so the market immediately rebounded, right? And that's why you've seen technology being so much up for this week. And even there, I was like, okay, I mean, I know that there are particular individuals, and when they talk, they can move markets around. But if this is the case, I mean, the guy basically is saying it since the last, for the last 2 months. But why it is relevant now to the upside, and it wasn't, where it was keep on saying the same stuff, but Nvidia was down like 4, 6, 7% a day. He was talking the same in terms of, guidance, earnings outlooks and whatnot, and yet Nvidia was down for the day or for the week. So again, it's to me it's just cherry picking and trying to confirm a narrative that you already have in mind, and you just want to have justifications for it. But I think it's very rare that the explanations you get from the mainstream media are actually reflecting what went on in the market. So to me, honestly, I mean, beside the fact that, as I said, it doesn't really impact my intraday type of behavior, but if I have to pick one explanation just for the sake of it, just for playing the game, right? I would tend to be more in line with short covering, getting into an important week. That would be it for me. It was a good run to the downside. Let's just take profits and see where it goes next week. That would be me. And because if you do believe that Nvidia CEOs was actually what was behind this huge reversal, then you would need to explain me why the market behaved this way every single day throughout last week. On the 9th, which was Monday, and no, what was the 9th was what? Wait. Yeah, it was Monday. On the 10th, which was the actual day of the debate, and then on Wednesday, when Nvidia CEO actually came up with that statement, I always did the same thing. Open, down, rally in the afternoon. Open, down, rally in the afternoon. Open, down, rally in the afternoon. It's not like we had the CEO of Nvidia talking his book every single day, right? Or it's not that we got Kamala Harris winning the debate even on Monday, the day prior, or winning that once again the day after it, right? So again, these are all justifications, and for me personally, I don't think you should pay attention to that, especially also because they always come after the fact. So how cool they could be, but I think not a lot, right? So this long video, cool. I mean, for being a week where I didn't scan a lot of macro stuff, I managed to put out a very long video. So let's end up with a quick look at currencies. Dollar still in this range, hovering around and just above the macro range. Uh, so far, pound and euro still drawing back. Didn't really reignite it, the pump. But the yen strengthening. So again, all these worrying about a carry trade are still present, I guess. The look, there is a good piece that you might want to read. You just need to Google or just look on Twitter. It should be on Twitter too. The Macro Alchemist, because they put out a very nice report about not only the yen carry trade, all right, but also they went through previous carry trades in history, historical carry trades. And from this report, which is based on history, so it's not something you can come up with. these events actually happened in the past, you can see that we got many examples of carry trades blowing up and having massive repercussions on the global financial markets. There was one in Mexico, there was one in Brazil, there was one in Australia, throughout the history. And basically, the point is that a carry trade often comes, if not always, with a huge amount of leverage. So somehow it's always a deleveraging event. And these are the links if you just wanna check that out, right? I would suggest you to have a look at this report because it's really good. And they put out reports like these once a week, I guess. It's hosted in collaboration with Brent Johnson. If you are familiar with the man, uh, famous for coining the term and the logic behind the milkshake dollar theory. If you want to check that out. So yeah, I mean, just have a look at this report, and I don't want to spend additional time talking about the yen and the carry trade. That report actually tells you the whole story. It gives you insights in the past. It gives you insights in the mechanics and the different types of carry trades you can come up with and how you might set them up and how they could unfortunately potentially unwind. So that was a good one. As for the rest, I guess that's it for me. It was even a too long type of video for this week, but hey, when you get lost in your train of thought, it's hard to get off of it. That being said, as usual, have a nice rest of the Sunday or a good start if you are in the US, I guess. And yeah, let's see what FOMC will be next week. It's probably going to be interesting. I guess one way or the other, just brace yourself for volatility because we are going to see that. All right. As usual, be nice and don't forget, be cool. Neil's out.